Kurt Henry here, mortgage broker at the Mortgage Center. We are your go-to mortgage broker in the Durham region, and this is a weekly mortgage market update, just to let you know what's going on in the mortgage market. So one of the big factors at the moment is what the Bank of Canada is going to do at the next Bank of Canada rate announcement dates. The next rate announcement is on June 7th, and after that it's July 12th. And then there's one on September 6th. The reason why it's becoming a hot topic is because not long ago there was a lot of thought that the Bank of Canada was done increasing rates and they wouldn't go up any further. There's been some information coming out, some reports coming out on the economy recently that would perhaps suggest that the Bank of Canada still has more work to do as far as increasing rates. But not everybody would say the same thing. It depends on who you talk to, which is why it makes it a little bit unclear on what the Bank of Canada is actually going to do in these upcoming rate announcements. So, for instance, we get an economist from Scotiabank that would say that the rate increases the Bank of Canada has done so far have not had the impact on the economy that they should, and therefore the Bank of Canada should increase further. But then you get a place like National Bank that would say that there's going to be significant decline in economic activity over the next 4 quarters, and therefore there's no reason for the Bank of Canada to do anything. At the same time, the Bank of Canada themselves have an expectation that inflation in May should be lower than what it has been. The challenge is that the inflation report in May doesn't come out until June 27th, but the Bank of Canada rate announcement date is June 7th. So the question is, will the Bank of Canada on June 7th make a decision to increase rates knowing that they haven't seen the May inflation numbers yet, when they expect the May inflation numbers to be down? A couple of other factors that would kind of make things a little more foggy would be the fact that unemployment has not really increased over the last number of months. And if unemployment increases, it's normally a sign that the economy is slowing down, which is what the Bank of Canada wants to see. They want to see the economy slowing down in order for inflation to come down. Unemployment hasn't gone up by any measure, so that's one factor that makes it a little more foggy. It could be a factor that would push the Bank of Canada to increase rates. Another factor is the GDP. GDP in the first quarter of this year came in at 3.1%, which is like the growth of the economy, came in at 3.1%, when the Bank of Canada expected for it to be 2.3%. So there's some factors there that are creating some uncertainty on whether or not the Bank of Canada will increase or not. Now, some people would say to me, Kurt, how is it possible that inflation is still maybe going up and the economy is still strong when all these rate increases have happened in the last year? And it often comes down to consumer spending still being strong. Some people would say, well, how is consumer spending still strong given all the rate increases? And there's a couple reasons. Government spending is one. Fiscal policy with government spending tends to make inflation not come down as quick as what people would like to see it. And access to credit is another one that can help consumer spending stay strong and therefore make the economy strong. One thing I just want to mention, though, to kind of put this, just a really important point. If the Bank of Canada does increase the rate, either on the next announcement or the one after that, there's no guarantee that fixed mortgage rates will go up as a result. In fact, the fixed rates might actually come down if the Bank of Canada goes up. You might say, well, how is that possible at all? That makes no sense. Well, the thing is that rates have a cycle. They go up and they go down. It's a rate cycle, and there's a top of a rate cycle, there's a bottom, there's a middle. When you're at the top of the rate cycle or near it, it's different than when you're at the bottom of the rate cycle. And what it comes down to is with inflation, sometimes the expectation of inflation is more important than inflation itself. And what can happen is if the Bank of Canada does increase the rates again, then what it could do is it could give the expectation that inflation will in fact start to come down quicker. And when we're talking about fixed mortgage rates, I've said it before, what impacts fixed mortgage rates? Bond yields. And what impacts bond yields? Those bond traders that are buying and selling bonds. If the bond traders think that inflation is going to come down, if that's the expectation, they may start to price that into their buying and selling of bonds, and it might actually bring bond yields down, which actually could bring fixed mortgage rates down. That's only if we're, at or near the top of the rate cycle. So there's a lot of factors there. Obviously, there's no guarantee that fixed mortgage rates will come down if the Bank of Canada goes up, but it is a possibility. So anybody that's looking at locking into a fixed rate because the Bank of Canada is going up, it's not necessarily a foregone conclusion that those fixed rates will jump up if the Bank of Canada increases the Bank of Canada rate. So if you have any questions on that, or if you need, some thoughts on what you should do with your mortgage renewal coming up, or your current mortgage, or if you're buying a house or wanting to refinance, just feel free to reach out and we'd be happy.